Back in 2022, the Nobel Prize in Economics went to some research that totally changed how we understand banks and financial crises. The winners, Philip Dybvig, Douglas Diamond, and Ben Bernanke, gave us this elegant, powerful, and honestly, a kind of terrifying model to explain what a bank run really is. So today, we're going to break down the brilliant logic behind it all.
I mean, think about it. It's a question that gets right to the heart of our entire financial system. We think of banks as these pillars of stability, right? But history is just filled with examples of them suddenly and catastrophically collapsing. Well, the work of Diamond and Dybvig explains this exact paradox. It shows us why banks are so essential, but also why that very same essential function makes them incredibly vulnerable. Okay, so to really get why we even have banks in the first place, we've got to start with a really fundamental problem, a basic conflict in any economy. It's this clash between two groups of people who want completely opposite things.
So what this really shows us is this deep tension at the heart of the economy. On one side, you've got savers. That's us. We want our money to be liquid, right? We want it available at a moment's notice for an emergency or a great opportunity. But on the other side, you've got borrowers, people starting businesses, buying homes. They need money locked away for years, sometimes decades. So the big question is, how on earth can the same pile of cash be two things at once? How can it be instantly available, but also tied up for the long term?
And that is where the bank comes in. You see, a bank isn't just a big safe for your money. It's this incredibly clever machine designed to solve this exact problem. And the secret sauce has a name: maturity transformation. Now, it sounds super technical, but trust me, the idea behind it is actually pretty simple and elegant. Banks take in money they might have to pay back tomorrow, that's your short-term deposits, and they turn around and use it to fund things that won't pay off for 30 years, like a mortgage. They literally transform short-term money into long-term growth. So how do they pull this off? Well, it's all about pooling the deposits of thousands, even millions of people. And here's the key insight, right? Well, you or I might need our cash today. It's just extremely unlikely that all of us are going to need it at the exact same moment. This statistical trick allows the bank to handle the day-to-day withdrawals while keeping the vast majority of our money working hard in productive long-term projects. So let's just break that down. It's this crucial three-step dance. First, they pool all our deposits together. Second, they make those long-term, illiquid loans, meaning the money is tied up and can't be pulled out quickly, that build our economy. And third, because that pool of money is so massive, they can still give us our cash whenever we ask for it. They create liquidity out of thin air, solving the puzzle. It's an incredibly valuable service to society, but, and yeah, it's a big but, this amazing solution has a massive hidden flaw. And this is where the work of Dybvig and his colleagues becomes just, well, Nobel Prize-worthy. He showed that the very thing that makes banks so incredibly useful is also their greatest weakness, their Achilles heel. And this brings us to the core, totally mind-bending insight from the Diamond-Dybvig model. The system's potential to just collapse isn't some mistake or a sign that something is broken. No, the fragility is a direct, unavoidable consequence of the bank simply doing its job. Basically, being able to create liquidity and being inherently unstable, they're two sides of the exact same coin. So to explain how this works, they borrowed a really cool concept from game theory: multiple equilibria. All it means is that for the exact same bank, in the exact same healthy financial state, two completely different outcomes are possible. And the crazy part? The only thing that decides which path we go down is what we all believe is going to happen. Okay, so let's look at these two realities. In the good equilibrium, everything's great. We're all confident, we trust the bank, so only people who genuinely need cash take it out. The system works perfectly. But then there's the bad equilibrium. A panic starts. Maybe it's a rumor, maybe it's just a vague fear. You start to believe that other people are going to pull their money out. And once that idea gets in your head, the single most logical, rational thing for you to do is to race to the bank and get your money out first, before it's all gone. It turns into a total self-fulfilling prophecy. And honestly, this might be the most important takeaway of the whole thing. A bank run isn't just a case of mass hysteria or people being irrational. It's a coordination problem where every single person is making a perfectly logical choice based on what they think everyone else is going to do. Your individual choice to get your money out is smart for you. But when everyone makes that same smart choice, the whole system collapses. It's a collective disaster born from individual rationality. Okay, so if this terrible outcome, this bank run, is actually a perfectly rational possibility that's just baked into the system, are we just doomed to live through financial crises forever? Well,
Not necessarily. Because here's the clever part. If the problem is all about expectations, then you can actually build policies to change those expectations. And that's why this model is just so powerful for anyone making policy. It shows that when the government steps in, it's not necessarily about bailing out a broken bank. It's about making sure a perfectly healthy bank doesn't get pushed over the edge by a simple crisis of confidence. And what's cool is the model points directly to the solutions we actually rely on today. Take deposit insurance. It's the most obvious one. If you know for a fact that your money is guaranteed by the government no matter what happens to the bank, well, your incentive to run completely disappears. The bad equilibrium just vanishes. Same idea with the central bank acting as a lender of last resort. It's a promise that even in a panic, the cash will be there, which stops the panic from ever starting. So the real takeaway here is we need to reframe how we think about this stuff. These policies aren't just reactive bailouts after things go wrong, they are proactive design choices. You can think of it as equilibrium engineering. Basically, designing the rules of the financial game so that the good, stable outcome is pretty much the only one that can happen. You really can't overstate the impact of this deceptively simple model. It caused what economists call a structural rupture in how we think about finance. Now, a structural rupture, that's not just a new idea. It's a whole new way of looking at the problem. It gives you a new language, a new framework that completely changes the kinds of questions economists ask and the kind of answers they look for. And that is exactly why this work was recognized with the Nobel Prize. It gave us a formal, logical way to understand financial panic. It took the idea of a financial panic out of the fuzzy realm of just psychology and placed it right at the logical core of economic theory. Think about it like this. Before Diamond and Dybvig, most economists thought of bank failures as just a sad symptom of a bad economy. But their model totally flipped that script. It showed that the banking system itself, just by doing its essential job, creates a deep-seated fragility that can actually cause or dramatically amplify an economic crisis. The danger wasn't coming from the outside. It was endogenous. It was built right into the very architecture of modern finance. And all of this leaves us with a really important question for today, right? The world of finance is always changing. We have shadow banks, crypto platforms, all kinds of new things that are doing a very similar job of maturity transformation, but often without the safety nets like deposit insurance. So the question we have to ask ourselves is this: does any system that promises you instant access to your money while tying it up in long-term investments carry the exact same risk of a self-fulfilling crisis? The fundamental logic of a bank run hasn't changed, and in our world today, understanding it is probably more important than ever.